Hello, everybody. My name is Steve Bigelow with the Candlestick Forum. Happy New Year. And I hope this year goes a lot better as far as our economic and our political strifes in the U.S. However, as far as trading in 2021, it was a very good year because of a very simple premise. You let the markets tell you what the market is doing. You've probably heard every prognosticator tell you what they think the market's going to do in 2022. I can rest assured that none of them have any idea what the market is going to do in 2022. That's why we let the market tell us what the market is doing. So we were looking to see what type of investor sentiment was coming out of the chute today in 2022. It's a very strong indicator for seeing how strong a market's going to be or what the nature of the market's going to be on the first trading days of the year. As we can see, today the market opened positive, but it wasn't really rambunctiously positive. It was up about 60 points on the Dow most of the day, and then near the end of the day, it started moving up steadily. So it wasn't like everybody was rushing in because of the decisions they'd made over the holidays. It was kind of a continuation of what the existing trend was telling us. And here's the most important factor that we witnessed today. Look at how the T-line once again acted as support. Notice the type of pattern that's setting up on the Dow after supporting at the T-line. There's your J-hook pattern. And what's our expectation? Well, if this opens positive, confirming the breakout, wave one, wave two, wave three should be the same magnitude as wave one, telling us the bullish sentiment is still here. It didn't come out of the chute with great force, but it basically told us that the profit taking that was occurring going into the end of the year before today was basically profit taking. They came right back to the T-line on the NASDAQ. Same scenario. If we see the pre-market futures showing more positive open tomorrow, that gives us a J-hook pattern that tells us this level is probably being broken. Wave one, wave three, up above this level somewhere. And you can see what happened on the S&P 500. They consolidated today, and where did they consolidate to? Right smack dab to the T-line and starting back up. Same scenario as the rest of the indexes. If they open positive, breaking out through here, wave one, wave two, wave three, bouncing off the T-line with a hammer morning star type signal, that means the uptrend is still working. We can see that in some of the biggies. Look at our trend expectations for Apple. Consolidated, and when I say consolidated, notice how indecisive the pullback was. That is illustrated in the individual candlestick signals. A doji pullback pretty much tells you there's really not that decisive selling going on. It's indecisive, and as soon as they came back to the T-line, they took off again. If this goes into wave three and this little pattern, what's this tell us about our resistance level? It's not going to act as resistance. We could be in another wave of this magnitude. So when we know the market is heading up, what we're looking for is the highest probability trade setups. We knew that the electric vehicle sectors was picking up a little bit of steam during the final days of last year. And look what Lucid did today. There's your morning star signal, followed by your doji sandwich, your McMuffin. And what's the probability factor of a McMuffin? First of all, your morning star signal is one of your 12 major signals, a very high reversal signal. What's the results of a doji sandwich? More upside. So you've got a reversal plus indication of more upside. That's kind of a double guarantee or double whammy that you should be trading higher. Makes your entry strategies very simple. You could be buying on positive trading, or you could be buying if they trade up above the 50. Again, we call this 2+2 analysis, where you put everything that we know should be expected from a candlestick reversal signal and where everybody else is watching to add the probabilities that you're going to be in a correct trade. Patterns provide high probability setups. The classic pattern, your fry pan bottom followed by a J-hook pattern, tells us wave 1 and wave 3 will be approximately the same, a very high probability trade setup. Now, there's two facets of investing. You can be looking for that big price move, which we can do relatively easy with the candlestick analysis. Or you could be looking for that high probability price move and then figure out your best trading strategy, whether you're buying stock, buying calls, or call spreads. Anything that can enhance the value of that trade based upon knowing the high probability expected results. So we saw that same thing. Whoops, missed. Oh, sorry. Saw that same thing. There's our morning star signal, smack dab off the 50. If they've come back and supported at the 50, what is the next high probability target? The 200-day moving average, which would create a wave 1, wave 2, J-hook pattern, wave 3. Again, a place to be buying either stock, calls, or spreads. At least you have the advantage of seeing where the high probability trade setup is likely to move to. So a pattern is very easy to identify. As we see in Tesla, there was a little J-hook pattern pullback after it failed here at this resistance level. And today, with kind of a trend kicker gap through, that pretty much tells you this level is not acting as resistance. Get ready for wave 3. We also know when to get out of trades. And this is something that we kind of pound in everybody's head, that if you're in an overbought condition and you start seeing a resistance level, pick a logical spot that tells you shouldn't be trading in this direction. The doji rule said put your stop just below the low of the doji, which supported at the T line on Friday. If it came back down through that level, what's it telling us? The doji rule, they're moving in that direction. Same scenario on our trade of RDWR, the doji alert. Remember what the Japanese rice traders illustrate for us. If you start seeing dojis in the overbought area, use the doji rule. If it opens lower the next day, get ready to close it out. If it trades back below a level that it shouldn't be trading, close it out. And definitely, if you didn't do that, you definitely would close it out when it started trading after dojis in the overbought condition back below the T line. I always express that this is not rocket science. This is merely identifying what the Japanese rice traders have illustrated to us for hundreds of years of what happens in human nature. So right now, if we can identify a pattern setting up in the Dow, we know exactly what to be doing. If it opens positive, we're going to be trading positive. If it opens lower, it's telling us this level is acting as resistance. You don't want to be buying aggressively. You want to be looking to close some positions. That'll be it. We'll hope that your trading has improved dramatically into 2022. We're going to make some good money this year. That'll be it. We'll see you in the chat rooms.